For more on tech, let's bring in Foundation Capital General Partner Paul Holland, as well as Gabelli Funds Portfolio Manager Larry Haverty. And Larry, I'll turn to you since a rare visit here to the NYSE for you.
Good to be here.
Your fund had a good year, up 27%. Correct?
Yes.
All right. I'm looking at your letter, though, and it's always interesting to look at some of the things you feel like you didn't do as well as you might have. And you say, what did not work? Missed opportunities. The most prominent fruits we did not enjoy were Netflix and Amazon. In considering these firms as investments, we made most of the mistakes in the investment book, failed to understand the potential of Amazon Web Services, also underestimated the value of Amazon acting as a marketplace. Does that change for next year, or how does it inform your thinking as you move into next year?
Well, I think the big thing that's going to be different next year, David, is that interest rates are going to go up. We're talking about natural gas prices going up, commodity prices like copper going up. There's going to be inflation. Retail sales were very strong in the fourth quarter. We're going to have probably higher than expected GDP. The Fed is going to be raising rates. The consensus forecast is three times. That's going to mean that interest rates go up. That should affect the valuations of the tech stocks at the highest end of the valuation stream. So if we look at where we are right now, Amazon's at about 40 times operating cash flow pre-tax. Netflix is about 100 times operating cash flow pre-tax. These multiples are very vulnerable to higher interest rates. I started out in the 1972 period with the Nifty 50, and we had Kmart selling at 50 times earnings, and then it was selling at 10 times earnings, and it wasn't very pretty.
So you're concerned at this point, your concern would continue about the multiples, particularly versus cash flow for some of these incredible growth stories.
You have the multiples, but then you have business issues. And I think the business issues are more obvious at Amazon. First of all, the government has just given their competitors a raise. And they did that by lowering the tax rate. So if you're Macy, you're going to be operating, and Macy's the fifth largest guy in e-commerce besides having the landline stores. You're going to be operating and have the ability to reduce your prices 15% because Amazon doesn't pay taxes. Now, whether you do or you don't, you give it to your employees, you give it to the shareholders, but you do have the flexibility. So the internet commerce in the United States is going to get a lot more price competitive. And Amazon, in its value, has the idea that at some point it's going to harvest the profits. It's going to be very difficult for it to do that this year. Second thing, you have to be worried about antitrust. Just picking up the paper this morning, there was another bookseller that went out of business, and they commented that how can you compete against somebody that doesn't make any money? And Amazon, the way I look at it, and I've been looking at retailing for more than 2 decades, they really don't make an economic profit in retailing. And at some point, especially when the president's talking about them even as late as this morning, there's got to be issues. So Amazon, I think you have a problem. You're going to have a very good fourth quarter. You have the dollar behind you, but there are storm clouds on the horizon, and I don't think they're going to go away.
Paul, do you see those same storm clouds?
Yeah, I probably see it a little bit differently than Larry from that perspective. So if you look at the 2017, really the big part of the tech story are the FANG stocks, of course. You've got folks like Apple and Google / Alphabet that are already nearing the highest market capitalizations in history. You've got Facebook, you've got Netflix that have just roared on. And if I look at those companies, I look at Amazon, I look at the other players that are out there, what I'm seeing is this notion that really it's this idea that our friends at Andreessen Horowitz put forward of software eating the world. And each one of those industries were industries that were not primarily driven by software and by technology, but now they are. And so I'm a little less concerned about, and I'll be quite blunt, if I'm sitting in Amazon's boardroom, I don't give a frog's fat behind about Macy's. I'm not worried about them at all. I'm worried about other software-driven companies that are competing against me across the board in my empire, competing against me in media, competing against me in shipping, across the board. I think it's a completely different kind of dynamic. So I'd say 2017 was really guided by the FANGs and the growth and the breakout into maturity of those large stocks. If you look forward into 2018, I think we've got a very exciting story, but a very different story.
Paul, is it an investable story? Are there potential disruptors to these tech giants that you would invest in here?
Absolutely. So if I think of the 3 big drivers that we look at coming forward into 2018, we've got a few things going on now. One is the explosive growth in AI and ML. So if I look at, on the public sides, a company that I'm sure that Larry and his team are following in NVIDIA, they're up $100 billion in the last 18 months in market cap. But they've got some very significant up-and-comers like Cerebras and other companies that are going to go after that empire as far as the underpinnings of AI and ML and the computing paradigms that are behind that. If you look beyond that, look at cybersecurity. Look at some of the intense growth that we're seeing there, and also applying things like AI and ML towards that. Companies like Response Software in our portfolio that are working in that dimension.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.